China's strengths in electric vehicle sector are undeniable. China produces some of the most affordable and efficient energy efficient vehicles in the world. And in order for Canada to build our own competitive EV sector, we need to learn from innovative partners, access their supply chains, and increase local demand. And to help deliver the full potential of these partnerships and bring down costs for Canadians, Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians. It's expected that within 3 years, this agreement will drive considerable Chinese investment in Canada's auto sector, creating good careers in Canada and accelerating our progress towards a net zero future and the auto industry of the future. With this agreement, it's also anticipated that within 5 years, more than 50% of these vehicles will be affordable EVs with an import price of less than $35,000.
North America just woke up to a trade shock most people didn't see coming. Canada cut a deal with China that could reshape the continent's electric vehicle market. And it landed at the worst possible moment for North American unity. Because Canada's exports to the United States have fallen to their lowest share since 1997. Tariff pressure from Washington has been tightening the atmosphere. And the USMCA review cycle is approaching fast. Now add the contradiction that makes this story politically combustible. Mark Carney called China the most serious security threat to Canada. Then he went to Beijing and signed a major trade deal anyway. So the question isn't why the hypocrisy. The question is leverage. Because in modern trade politics, countries don't just trade goods. They trade exposure, they trade vulnerability, they trade options. Now here's the breaking update, clean and simple. Canada agreed to slash its tariff on Chinese electric vehicles from 100% to 6.1% for up to 49,000 vehicles per year under a quota. And in exchange, China agreed to cut its tariff on Canadian canola seeds from 84% to about 15%. China also removed tariffs on Canadian canola meal and lifted duties on several other Canadian exports, including key seafood and agricultural goods. This is not a symbolic handshake deal. These are numbers that change incentives. These are numbers that move markets. And these numbers come right as Canada is trying to reduce dependence on the US market. In plain terms, here's the early scoreboard. Winners include Canadian consumers, Canadian farm exporters, and Chinese EV makers. Losers include US automakers facing new price pressure and Washington officials watching their tariff wall get tested. And the biggest risk is a two-tier EV market inside North America, one partially open and one aggressively closed. Now let's move into the immediate reactions, because reactions tell you where pressure will go next. Washington reacted sharply. US lawmakers warned that Canada's decision could undermine American automakers and create new competitive pressure right on America's doorstep. Their logic is straightforward. Even if Chinese EVs don't physically cross the border into the United States, the competition still crosses. Price comparisons cross. Consumer expectations cross. Political pressure crosses. If Canadians can buy capable EVs at much lower prices, US consumers will notice. And when consumers notice, automakers face price pressure. When automakers face price pressure, they lobby. And when they lobby, policy hardens. So Washington's fear isn't just backdoor imports. It's the optics of a widening price gap. It's the political heat that follows. And the likely response is familiar. More security framing, more restrictions, and more pressure on Canada to align with US policy. Now here's the TradEconomics lens. This isn't just a trade deal. This is Canada building options inside a leverage system. Because when access to the US market starts to feel conditional, dependence becomes expensive. And when dependence becomes expensive, rational states hedge. Now let's break down why Canada made this move. Not emotionally, structurally. Start with the signal that should have made every policymaker nervous. In October 2025, Canada's exports to the United States fell to their lowest share since 1997. That is not a small fluctuation. That is a structural marker that the balance is changing. For nearly 3 decades, Canada's economic identity has been built around one gravitational center, the U.S. market. Factories, logistics, pricing, and supply chains were optimized for it. So when the U.S. share drops to a multi-decade low, you're watching the trade map start to shift. Now combine that with tariff pressure. Here's a critical point that mainstream coverage often misses. Tariffs don't only hurt when they land. Tariffs hurt when they become plausible. The moment firms believe tariffs could escalate behavior changes, investments get delayed, long-term contracts become harder to sign, expansion gets postponed, hiring slows, and Plan B becomes more attractive than Plan A. So even when tariffs are paused, the uncertainty still bites. And even when tariffs are negotiated, the threat still shapes decisions. There was another tell in Canada's trade picture. Without a surge in gold exports during that period, Canada would have posted a multi-billion-dollar trade deficit. That matters because it shows the system compensating. When precious metals begin to mask weakness in everyday industrial flows, it often signals stress under the surface. So Canada is facing pressure from 2 directions, a market dependence that feels less stable, and a tariff environment where policy can swing quickly. Now remember, this is happening right as the USMCA review cycle is approaching. And that matters because review cycles amplify leverage. You don't even need the review to be tomorrow. The mere approach changes posture. It changes bargaining psychology. It increases threats. It makes everything feel conditional. So Carney's trip to China becomes easier to understand. It's not a love letter to Beijing. It's insurance against vulnerability. It's diversification before the continent enters a more hostile phase of negotiation. Now let's go deeper into the EV part, because EVs are not just vehicles anymore. EVs are industrial strategy. They are battery supply chains. They are critical minerals. They are manufacturing ecosystems. They are geopolitical power. By cutting tariffs on Chinese EVs down to 6.1% under a quota, Canada introduces real Chinese competition into its EV market. And that changes the market quickly. Consumers get lower prices and more options. Competitors face new pressure. Dealers gain new product lines. And the entire pricing structure shifts downward. This is why the quota matters. It's controlled entry, not a full open gate, a calibrated opening. But even calibrated openings have big consequences because they set a precedent. They establish a pathway. They prove market access is possible. And they attract attention from manufacturers and investors who think in 5- and 10-year horizons. Now look at China's incentives. China's EV industry runs on scale, and scale needs markets. The US has built a wall, so a G7 market like Canada becomes strategically valuable. China gets export volume, China gets revenue, China gets a foothold in North American consumer space. And China gets a narrative win. We trade, we cooperate, we build partnerships. Now, whether you accept that narrative or not, the point is simple. It plays well in a world where Washington is increasingly tariff-driven and unilateral. Now, shift to the agriculture side, because canola is not a footnote. China cutting canola tariffs from 84% down to around 15% is a major win for Canadian farmers, especially in the prairies. Removing tariffs on canola meal and other Canadian food exports broadens that relief. It stabilizes revenues, it opens channels, it reduces vulnerability to a single buyer. For China, it's also strategic. Food security matters, diversifying suppliers matters, reducing exposure to political shocks matters. So both sides are doing what rational actors do in an unstable system. They are reducing exposure. They are buying flexibility. They are building alternatives. Now let's address the political contradiction directly, because your viewers will. Yes, Carney's security rhetoric clashes with the trade outreach. Critics will call it hypocrisy. Supporters will call it realism. The TradEconomics view is more blunt. Security rhetoric is posture. Trade decisions follow incentives. Carney can believe China is a security risk in intelligence terms, cyber, espionage, influence, and still believe Canada needs Chinese markets and supply chain options in economic terms. Those two realities can coexist, even if they create political discomfort. And the more tariff pressure rises from Washington, the more that discomfort becomes tolerable in Ottawa. Now we move into consequences, because this is where the story becomes continental. First consequence: North America becomes more economically bifurcated. Canada partially opens a channel for Chinese EV competition under quota. The US remains closed under punitive tariffs and national security framing. That is a divergence inside an integrated continent. And divergence inside integration creates friction. Second consequence: US political pressure intensifies. If Canadian EV prices fall because Chinese competition is partially allowed, US consumers will notice. And US automakers will respond. Expect louder calls for stricter rules. Expect demands for tighter alignment. Expect USMCA discussions to get more politicized. Third consequence: Canada's bargaining posture shifts slightly but meaningfully. Canada cannot replace the US market overnight. That is reality. Supply chains are deep. Auto parts cross borders multiple times. Energy networks are integrated. Manufacturing is optimized for North America. So this is not a breakup. It is a recalibration, a hedge, a slow reweighting. But even a slow reweighting changes bargaining psychology. Because in leverage politics, the weakest actor is the actor with no alternatives. And the strongest actor is the actor who can walk away. Canada is trying to build enough alternatives to make walking away not likely, but imaginable. That alone changes the negotiation atmosphere. Fourth consequence: the feedback loop becomes more dangerous. US pressure pushes Canada to diversify. Canada's diversification triggers US pressure to increase. And that is how trade wars become structural even without declarations. Now let's connect all of this to the USMCA review cycle clearly. The USMCA review is a forcing mechanism. It turns uncertainty into leverage. It creates deadlines, it hardens positions, it amplifies threats. So a Canada-China reset landing near this review period is not neutral. It affects posture, it affects tone, it affects bargaining narratives. Washington can frame Canada's move as disloyalty. Ottawa can frame it as insurance. Beijing can frame it as multilateral cooperation. But the power reality underneath is Canada is signaling it has options. And Washington's core weapon has always been conditional access. So this becomes a contest of signals, and contests of signals often turn into contests of tariffs. Now here's the final trade economics take. Carney's China trip is not the cause of North America's trade stress. It is confirmation of it. Canada is moving like a country preparing for leverage politics. China is moving like a power-expanding market footprint and influence. And the United States is reacting like a hegemon whose tariff wall is being tested by its closest partner. This deal is not just about EVs and canola. It's about bargaining posture. It's about vulnerability. It's about options. And it's about a continent drifting into a new phase where trade rules feel less stable and power contests feel more open. So here's the question that matters. Is this smart insurance by Canada? Or is it a risky move that provokes Washington into harder pressure, making the next USMCA cycle even uglier? Drop your view in the comments. Does Canada's China hedge strengthen its sovereignty? Or does it accelerate North America's slow-burn trade war? If you want market-first reporting and power-second analysis in every episode, subscribe to TradEconomics and turn on notifications. Because trade wars don't always start with declarations. Sometimes they start with a contradiction, and sometimes they start with a data point.